On paper, this company was worth $3.7 million, but I sold it for $25 million, not by luck, but by design. We didn't pray for a buyer, we manufactured competition. And by the end of this video, you'll have the 3-step playbook I used to make all this happen. Hi, I'm Nate Lynn. I sell companies like realtors sell homes. Specifically, businesses where the owner runs them remotely, like e-commerce, technology, internet companies, and professional service firms making anywhere between $1 to $30 million a year. I've been selling companies for over a decade, and in the last few years, I've sold 20 companies for over $121 million. If your business has strong cash flow and a buyer can run the business from any location, chances are I already know someone who wants to buy it. In fact, if that's the case, I guarantee I can bring you 30 serious buyers and get you an LOI in less than 4 months. California Beach Company is a family outdoor brand best known for the Pop and Go. It's a portable pop-up playpen for kids and pets that sets up in seconds with a breathable mesh. It's simple, durable, and lightweight gear for living rooms, backyards, beaches, or travel. They originally launched on Kickstarter, then migrated over to Shopify and continued to innovate and add additional products and variations. California Beach Company wasn't just an idea on a napkin. It was a real business with sales, customers, and profit right from the start. And it had real EBITDA to prove it. But a strong business doesn't automatically mean a solid exit. Valuation is just theory until the market proves it. The owners, Austin Wright and David Shoham, have given me permission to share more details about what happened inside their transaction. In fact, Austin even endorsed me by writing the foreword to my book, Maximum Exit. They'd built something they were proud of, and when we first connected, they weren't sure exactly what to do next. They had two options: either raise money and keep grinding, or maybe sell the business. I had no agenda. I shared the upside of selling, which was to get some cash now and see a little upside later if they'd be willing to hold a little equity with the right partner. It was a great company, built by great founders, but not yet sellable at a premium. And my job was to fix that fast. The first thing I checked was how inventory was managed. For a company doing about $2.9 million in sales, everything was kept in spreadsheets. Multiple versions, conflicting counts. Do we have that color in backstock? Was a weekly question. It's not just a mystery, it scares buyers. If they can't trust your numbers, they won't pay a premium. So we moved them off of spreadsheets into a proper ERP inventory system. SKU level tracking, clear reorder points, and a simple weekly review. Now, in transit, on hand, and shipped to consumer were all speaking the same language. Stockouts dropped, and cash stopped getting stuck in slow-moving SKUs. Margins stabilized. That predictability is what buyers pay for. And this is where the rocket fuel started. Clean operations and strong cash flow meant they could scale with confidence. By the time we closed, their sales grew from $2.9 million to $21.4 million. Inventory clarity didn't do that alone, but it made the entire story trackable. And trackable EBITDA growth is what turned what was a $3.7 million valuation originally in the beginning into a $25 million exit. The next problem buyers hate: single channel dependency. Great brand, but too much of its sales were tied to Shopify. Buyers see risk, not scale. So I helped them get launched on Amazon, not to cannibalize the core, but to prove repeatable demand off Shopify. We did the basics: clean listings, credible reviews, and disciplined ad scaling, all while protecting the core business on Shopify. The goal wasn't hype, it was proof. Show buyers that the brands sell wherever the customers shop. Less risk, more buyer confidence, higher exit multiple. Good numbers don't sell themselves if they're scattered. So we built one buyer-ready source of truth, which showed a simple, clean monthly P&L, clear cash flow, and simple SKU level economics. We also showed returns numbers, platform diversity, and a one-pager that answered, where does the next dollar of growth come from and how much does it cost? When we listed, everyone saw the same numbers, the same story, at the same time. The results? Buyer calls got shorter, Q&As got tighter, and the offers got more competitive. The offers had more cash up front and tighter back-end timeframes. My packaging didn't create the growth, but my story and their numbers made the growth predictable and believable. And that's what gets you paid. How we engineered the bidding war. Once the company was buyer ready, we didn't just list it in hope. We built an auction with rules, our rules. Step number 1, pick the room, not the crowd. We had 83 interested, strong, incredible buyers with funds ready to deploy. From that, I built a short list, the best of the best. Buyers that could actually demonstrate they can close. A few strategics, some private equity sponsors, and a couple of family offices that could prove to me they could demonstrate actual past closings. Everyone got the same one-pager. If you wanted in, you signed the NDA, and then you got the SIM, a monster document with all the information about the business. And they got the financials. No favorites, no side doors. Step number 2, we set the clock and ran a sprint. Week 1, review the materials. Week 2, one-on-one meetings with the strongest buyers. Week 3, second round of meetings. Week 4, best and final offers. Same deadline for everyone. When everyone moves on the same timeline, urgency takes care of itself. Step number 3, the art of the counter offer. The best price and the best buyer. We weren't going to counter offer everyone. That's a bad move. We made sure only the best and final offers hit the table. None of this used car haggling back and forth. Once we did that, my inbox lit up. The offers stacked up. We had more than a dozen LOIs to pick from. That's when valuation stops being a theory and becomes a real price. Because now buyers are competing with other buyers. We're not negotiating in a vacuum. From there, we take the highest price offer and we counter it against the buyer who's the most likely to close, who usually isn't the highest price. That gives us the highest price with the highest likelihood to close. How you choose in a bidding war matters. The biggest headline isn't always the best outcome. We asked and answered 3 simple questions on every offer. 1, how much money lands on day 1? 2, can this buyer actually close fast? 3, are they a good fit for the brand and the team? Selling a business is a little like selling a house. Do you take the all-cash buyer who can close by Friday, or a shiny number that needs a bank and takes months? The second one can sometimes be a ticking time bomb. Time kills deals, and we don't want that. Midway through, one frontrunner wobbled on terms. That's why we engineer competition. We kept the other finalists warm and ready to step in if there was any hesitation or problems with the forerunner. That enabled us strength in negotiating and tightening up the structure with the forerunner. More cash up front, cleaner conditions, a shorter time frame, and we kept the momentum. In the end, we picked the buyer with the best possible combination. A strong fit, high cash on day 1, and the highest likelihood of closing. That's how a $3.7 million valuation originally became a $25 million exit at the end. The market set the price, but we engineered the competition. We cleaned up the numbers. Since I too once ran an 8-figure e-commerce business, I helped grow their company by providing a recommendation to a great inventory management company, and also pointed them in the direction of an Amazon done-for-you agency that could step in and help them de-risk their platform dependency. Then we engineered a bidding war. This let the market set the price in our favor. For context, the business grew from $2.9 million in gross sales and $890,000 in SDE when we first started. And it grew to $21.4 million in gross revenue and $4.3 million in SDE by the date of closing. If you're running a real company and you want to sell for more, or just be sellable, I can help map and guide you and your business through this process. We'll figure out what buyers will love, what they'll ding, and how to structure a deal that gets you cash on day 1 and actually closes. If you're doing $3 to $30 million in revenue, hit the link below. Book a call. I'll show you where value is hiding and how to make buyers compete for it. What happened after this exit? Here's an update. There's a little postscript to this story. A few years after the acquisition, the aggregator that bought California Beach Company went bankrupt. When that happened, Austin and David wanted to swoop back in and pick up the company at a discount. And they picked me to help them navigate through the process as a buyer. That's a different chapter with some different lessons. But disciplined founders with a clear playbook can rebuild value, and I trust that they will. Anyway, that's all I have for you today, and I'll see you on the next one.